In India, non-banking financial companies were earlier regulated as per the banking laws, that is Miscellaneous Provisions Act 1963. The government also appointed committees to closely monitor and recommend framework for smooth working of these institutions. The recommendations were later used for policy formulation by the Reserve Bank of India, that is RBI. The RBI Act was amended in 1997 in light of such recommendations to describe the norms of working of such institutions. As per the Act, non-banking financial company is a financial institution, that is a company, a non-banking institution, that is a company whose principal business is the receiving of deposit under any scheme or arrangement in any other manner, or lending and such other non-banking institutions or class of institutions as RBI may specify with prior approval of government. The Act lays guidelines in respect of registration and net owned funds, maintenance of assets and reserves, several powers relating to regulation and information collection, duties of auditors, acceptance of deposits and repayment along with the penalties, and powers of RBI to intervene.
After studying this module, you shall be able to know about non-banking financial institutions or companies, learn about the functioning of these pseudo-banking institutions, evaluate how they differ from the conventional deposit corporations or banks. Non-bank financial companies, also known as NBFCs, are financial institutions which provide banking facilities and services without being a bank themselves. Such institutions are at times prohibited from accepting deposits from the general public. The functions and operations of these institutions fall under the purview of the banking regulations of a nation. The various products and services offered by NBFCs includes savings, credit and loans, investment, and money transfers. One of the most widespread form of non-banking saving institutions are post office, pension funds, and provident funds. These systems help to mobilize the excess funds through small saving schemes and time deposit facilities and have a larger coverage in terms of depositors. Post offices also function as saving institutions and are secondary to the commercial banks and cooperatives in India. Small saving schemes are special attributes of these institutions as they play a very important role in financial inclusion. The amount raised forms a part of the non-marketable debt of the central government collected through a network of post offices and their local branches. The fraction of funds over and above the national average collection is shared among the center and the state governments. Types of saving media under post offices includes saving banks deposit, cumulative time deposits, recurring deposits, national savings certificates, Indira Vikas Patra, Kisan Vikas Patra, National Savings Scheme, and Post Office Monthly Income Scheme.
There has been an upward trend in the generation of funds through small savings over the past 50 years, but has declined as a share of total banking and non-banking deposits. It was 83% in 1970-71 and fell to 24.3% in 2002-03. Total amount of receipts were 2,759 crore rupees in 1980-81, which rose to rupees 1,54,836 crore in 2006-07.
Provident Fund is a form of savings by salaried class, but has recently also launched scheme for the non-salaried people as Public Provident Fund scheme. It is a contrast-based binding or obligation without profit motive. The several schemes under PF includes Employees Provident Fund, Provident Fund Scheme for Industrial Establishments, Central and State Employees Provident Funds, Coal Mines Provident Fund, Assam Tea Plantation Provident Funds, and Public Provident Funds.
Provident Fund have been offering a rate of return of 8.5% since 2006-07 with facilities and restrictions to withdraw the amount deposited. The savings of households have increased from rupees 19 crore in 1950-51 to rupees 52,435 crore in 2001-02.
Now let us look at the factors for the phenomenal expansion of Provident Fund schemes. They are compulsory mandate for industries and other establishments, rise in coverage of such establishments, rise in activities and income of people, introduction of PPF and constant return. Pension plans offer a regular income to the investor post-retirement. The plans are sponsored by employers, government or labor unions. In India, Pension Funds Regulatory Development Authority was established in August 2003 to promote old age income security. Currently, there are three basic pension schemes, namely Employees Provident Funds, Employees Pension Funds, and Public Provident Fund.
Pension has remained a crucial source of income for the employees post-retirement. Government approved the investment based pension funds in 1994. Currently, there are three basic pension schemes, namely Employees Provident Fund, that is EPF, Employees Pension Funds, that is EPS, and PPF. EPF and EPS form the part of government employees pension scheme. Apart from this, there are banking employees pension scheme called BEPS, insurance employees pension scheme, that is IEPS, and privately administered superannuation fund through life insurance corporations, that is LIC of India. A new scheme called New Pension Scheme was introduced in 2003 with increased coverage of participants. Insurance holds an important objective in today's society. There always exists an uncertainty with regards to happening of an event, and that carries along and inherent risk. Financial markets to face these risks. Insurance thus provides a sense of security through risk mitigation. Insurance companies are institutions which charge a premium so as to cover the cost of risk and provide a protection against an adverse event. These premiums become a part of the reserves of the insurance company, which are later invested. It's a one-of-a-kind business where they earn income before the actual expenditure. Insurance is divided into life, health and general, that is property insurance. Insurance companies are long-term investors, especially in infrastructure development projects. The liabilities of insurance companies stretch over long term, and hence most of the investment of these institutions is in government treasury bonds, mortgages, state and municipal corporation claims. Major insurance companies in India include Life Insurance Corporation, that is LIC, General Insurance Corporation, that is GIC, National Insurance Corporation, that is NIC, Oriental Insurance Corporations, that is OIC, New India Assurance Corporation, that is NIAC, and United India Insurance Company, that is UIC.
Now, let us study about the insurance companies. One of the major insurance companies in India is Life Insurance Company, also known as LIC. These are institutions which charge a premium so as to cover the cost of risk and provide a protection against an adverse event. Insurance is divided into life, health, and general property insurance. Most of the investment of these institutions is in government treasury bonds, mortgages, state and municipal corporation claims. Insurance Regulatory and Development Authority (IRDA) was established in April 2000 to create a framework of regulation and design rules for registration of private sector companies in this sector.
.46% of total life insurance premium collection in 2001-2 belonged to LIC. Total premium income of life and non-life insurance companies amounted to rupees 1,81,971 crore as on 31st December 2007. Share of insurance sector in household savings grew to 15% in 2006-07 from 7.6% in 1980s. Total capital of life insurers were rupees 8,124 crore rupees in 2007. With opening up of the sector, foreign players brought in rupees 9,626 crore rupees. Insurance companies play a vital role in risk assessment and management by transferring the risk to third party. Conventional risk management policy involves insurance cover, but recent developments include asset liability management, cash flow testing, capital adequacy testing, and capital modeling. The major risks confronting the insurer are financial risk, operational risk, and market risk. These cover a larger bracket of threats like tax rigidities, loss of investment, profitability and solvency issues, human resources, and data mismanagement, etc.
The major risks confronting the insurer are financial risk, operational risk, and market risk. An insurer undertakes steps to evaluate and reduce the amount of risk. Risk identification, which involves in depth understanding of the nature of risk with its legal, social, and economic implications. Risk assessment, whereby the extent of risk and its plausible damage is calculated used past information. Risk treatment, it involves action policies of either acceptance of risk or its avoidance. Advanced risk reduction and sporadic policy review.
An investor is faced with the challenge of finding a suitable provider of units and rate of return. The mismatch between such providers and seekers is removed by a financial intermediary like a mutual fund. Mutual funds buys and sells securities on behalf of the investor cost effectively. The investors get units of investments made in a portfolio of shares but do not enjoy the voting rights as a shareholder would. Investment in mutual funds provide a risk spreading opportunity to investors along with benefits of enjoying a larger portfolio just like a large investor. The fund invests into several companies and instruments which are out of the purview of a retail investor. This process of diversification is cost saving as it reduces the brokerage cost considerably as compared to a similar investment if directly undertaken by the retail investor. Mutual funds not only invest on their behalf but also provide the investors expertise in the form of supervision of portfolio, investment consultancy, and analysis at a lower cost. Benefits of a mutual fund investment include economies of scale, diversification and risk spread, liquidity, low brokerage and other costs, specialized services and consultation, flexibility and high return potential to name a few. More than 40 mutual funds existed in 2006-07 with gross funds of rupees 1938,493 crore. Unit Trust of India or UTI held a dominant position. As per SEBI, 755 mutual fund schemes existed in 2007.
The mismatch between providers of suitable units and rate of return and seekers is removed by a financial intermediary like a mutual fund. Mutual fund buys and sell securities on behalf of the investor cost effectively, that is, economies of scale. Investment in MFs provide a risk spreading opportunity to investors along with the benefits of enjoying a larger portfolio, just like a large investor, that is, diversification and risk spread. The funds invested into several companies and instruments which are out of the purview of a retail investor and thus saves the cost on brokerage fee, that is, liquidity low brokerage, and other costs. Mutual funds not only invest on their behalf but also provide the investors expertise in the form of supervision of portfolio, investment consultancy and analysis at a lower cost, that is, specialized services and consultation. And flexibility and high return potential is another benefit that can be derived from mutual fund investment. In India, there exists a large number of small and disintegrated institutions which are privately owned. These are loan companies. These are deposit institutes which operate under partnership contract. They offer higher rate of return and the deposits are uncovered and uninsured as compared to a bank. Investment companies. These companies extend loan for commercial and consumption purposes. High purchase finance. High purchase finance is a form of loan based buying of goods and services. Lease finance. This form of financing involves acquiring an asset without actually purchasing it. The user of asset is called lessee and the owner of the asset is called the lessor. Housing finance. These loans consist of mortgage loans for land and building. Merchant bankers. Merchant bankers, as they are usually referred to as, are similar to banks but are more prominent in financing services and operate in wholesale finance. Venture capital funds. These funds provide technology and knowledge based capital funding. Factors of services. Factors of services work as specialized institutions ready to discount bills and letters of credit for the amount of purchases to be paid in future. Credit rating agency. They are special institutions which assign credibility values to financial instruments and corporations based on their solvency and brand value.
Let us now discuss in detail the other non-banking financial companies, loan companies. These are deposit institutes which operate under partnership contract. They offer higher rates of return and the deposits are uncovered and uninsured as compared to a bank. The investments made by these companies are not sound as they lend to small industries, retail business and self-employed. The rate of interest charged on these loans is exorbitantly high and carry default risk. These companies also operate schemes like gifts and prizes, recurring deposits and discounting of post-dated checks. There were 354 loan companies with net assets of 44,150 crore rupees. Investment companies. These companies extend loans for commercial and consumption purposes. Like loan companies, these institutions also work on closed networks and provide financial assistance, but at a high rates than market. The loans are catered usually to people with low creditability ratio and those which are delisted by the organized sector institutions. The reported companies are around 547 in 2006 with net assets of rupees 32,399 crore. Hire purchase finance. Hire purchase finance is a form of loan based buying of goods and services. Hire purchase is akin to installment credit but differ in technical aspects. The former does not transfer ownership until and unless the last installment is paid. The latter, since the day of contract, transfers ownership. The hire purchase facility in India is available for a wide range of goods like fast moving consumer goods, namely TV and refrigerators, automobiles, industrial and capital goods, services like medical fees and educational credit. Major loans are to middle income consumers and small scale industrial units.
In this module, you have learned about NBFCs, which operates like bank but also engage in other financial services. The institutions are regulated by RBI. Saving funds involve small saving institutions like post offices, pension funds, and Provident Fund, which are second to commercial banks and cater to larger audience with small saving kitty. Insurance companies cover the risk and uncertainties by indemnifying the insured in case of the advent of the event. Mutual funds are the source of diversifying and yet getting similar returns opportunities from securities and shares. Other NBFCs includes loan companies, investment companies, hire purchase finance companies, lease companies, etc.